Good morning, everyone. It's Michael from backtothefuturetrading.com. I want to thank you for participating in our analysis of the Emini S&P. We have some really great information coming up here for you, but before we start, please familiarize yourself with the CTFC and NFA disclaimers, as well as the required U.S. government disclaimers with regards to hypothetical trading, simulated results, the risks associated with futures, equities, stocks, foreign exchange, and options trading. Remember, you can lose your principal investment, sometimes more, with leverage. Trading is highly risky and requires you to be aware of those risks. Also be advised we are not commodity trading advisors, and that all information and material provided by us during these videos is for educational and research purposes only and should not be considered specific investment advice. No representation is being made that any account will or is likely to achieve losses or profits similar to those discussed in any material provided during this video. Thank you for familiarizing yourself. Please pause the video and read through that disclaimer thoroughly to make sure you understand the risks involved. Alright, that stated, we are continuing to trade alongside the movements of the Emini S&P, and it's just been an absolute dream come true in terms of our research of this market and understanding where banks were taking it and why. If you joined us last Friday in our live Friday demonstration, you understood that we had forecast this move right here. We knew exactly that, or we had a very good idea with a high degree of certainty that because of the patterns involved, the timing of those patterns, the banks were going to take the markets up to where I'd drawn these two pink lines, and I had put the levels there on the chart for you last Friday if you joined us during our live demonstration. Well, I want to talk to you a little bit about where we are in our cycle analysis now and help you get a feel for what to expect moving forward with the Emini S&P as we go forward into the market today. The indicator that's on the right hand side of my chart is the Flux Daily Cycle Marker indicator, and the Flux Daily Cycle Marker indicator is a predictive tool. It has a series of 4 phases that repeat over and over again. So we sort of have a phase 1, a phase 2, a phase 3, and a phase 4. And the phase 3 in this last little Kumasiyama was covered up there, that little red dot. And then you'll see down below here that the signals for the phase 1 and the phase 2 kick in again. Phase 1, phase 2, and now we're at the phase 3 event. We're at the phase 3 event, and the phase 4 is coming in 6 days and 9 hours. So there are a few things here worth noting. Number one, when we look at what happens at a phase 3 event lately, there's something significant occurring in each of those sort of events, or at least the majority of the time there tends to be a bearish pullback around that date. There tends to be a bearish pullback around that date, even if it's a little one. Now, this is especially true when the phase 3 is near a high. So for example, you'll see here that the phase 3 near the high drives price down. The phase 3 near the high here, which was an all-time high, drove the price down. This phase 3 is closer to the low and drove price up. This phase 3 was closer to the low, in fact was the low, and drove price up. So in terms of where it is in location to structure, the banks drove price up into the phase 3 each of these two prior times before they dropped it. And you can see here that they drove this into an even higher high. So of all of the available phase 3s to cross-examine, this one most closely matches the ones that are circled here. And that's important because banks follow plays like a football team follows plays from a playbook. And this play right now, for all intents and purposes, is matching what we've seen here in the past, in particular March 20th and June 19th. Okay? Now, the play that we studied on Friday involved this price pattern, what I call a constellation. We have the pattern starting at a phase 4 and then terminating at a phase 2. Let me show you what I mean by that. So on Friday we talked about the pattern, this pattern here that I've highlighted with yellow triangles, starting at a phase 4 and then ending where it launches up out of that area at the phase 2. And over here the same thing happened. It started at a phase 4 and launched up at a phase 2. So this told us that the banks were running. If you were fishing, this would be a fish that bites your hook and then just runs out into the ocean and pulls your drag out. Just a runaway. And we had every idea that it would go a certain distance. That is to say, watch the following. Ready? The width of this pattern. I'm going to pull the rectangle close right there. Watch what happens in terms of the geometry that the banks were following. If I make a copy of these two rectangles, I'll put this one up at the top, and then I'll make a copy of the one on the bottom. You'll see that the banks replicated this 4-2-4-2 pattern identically. Okay, so the gap of that area was identical. Once we saw that the gap was identical, we said, well, what about this next area? Because it seems to be that the market then consolidated between these two resonant angle lines here for almost a week or more before it popped up. But there was a drop when it got to that high. Okay, so one of the things we can do is we can measure how far up price went from that pattern, right? So I'll copy that green arrow and I'll put it up here. And then I'll copy that again and I'll put it down here. And then I'll copy this line angle here, this thick blue line, and I'll put it up and connect the tops of those green arrows. So you see what I did there? So I transferred this thick blue line from here to here. Matter of fact, let's label that. We'll just call it the let's call it home base, because that's where the banks ran to. They ran to that home base line, and now we have kind of home base number 2 up here. Now there's a little gap in between home base and let's call it first base. So we'll go ahead and call this one first base, the next one up above. And so I'm going to copy that and I'm going to paste it up here. And we're going to take this green arrow. See how the basic width of it is about the same? One of the things we can do to make this simpler is use a really great tool from Ninja called the trend channel. And so I'll take the bottom line here, I'll move it up to there. So I have the trend channel just to make sure that my home base is in the right spot, and it is right there. Then I can take that trend channel a second time on my first baseline, connect it back to my home base, and now just copy that up to make sure it's in the right spot. Okay, so everything now matches. So far so good. So now over here we'll see that when we're in between first base and home base, there's a vibration that occurs. The market is sort of vibrating back and forth between first base and home base for a while. It doesn't exceed that level. Does everyone see what I mean by that? It doesn't go past first base. If anything, we make it hot pink. It behaves more like resistance up here. At least that's what the banks did when they ran this play the last time. Home base becomes support. And you can see now for 1, 2, 3, 4, 5, 6, 7 days, 4 out of those 7 days, it touches home base and launches up. And these are pretty significant moves. From each of those touches back up to the top, this 12-point move. So that's $20, $50 every 2 points. No, yeah, $50 a point. So that's $500 moves off of these baselines right here. So home base becomes really important, and I'm going to save this workspace and attach it to the email so that you guys can pull up these angles on your own chart. And even if you don't have the Flex software, you're going to have my construction lines, and hopefully you'll be able to use these construction lines in your own research. So when we're looking at the values, I want to specify for today where I think you should be watching for resistance and support, and I'll just put these into the notes for today in the video. So the top one is 24.66, 66.25. So we'll say 66 quarter area. The next level down, our home base for today is 53.50. We've seen that number come up a lot. And 53.50 also has horizontal significance. So today the ES is going to have a lot of support and a lot of resistance from 53.50. There's another resistance level right here. I won't go into the study that got us to this point horizontally, but that's 59.75. So the top of today is 59.75. And these are levels that you can use throughout the day. The next level down here is, if we break through home base, 47.25. 47.25. Cha 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 cha. And then all the way down here, just to give you some sense of where we're at, is 32.75. Okay. So now we've got the home base, we've got the first base line. Let's take a look at the 60-minute histogram for the Emini S&P and get a feel for what the dynamic is today. Looking at the 60-minute histogram, there are 3 things to take note of. Number one, if we follow what's been happening here, the high occurred yesterday at 4 p.m. or I'm sorry, 2 days ago at 4 p.m. and we see that higher high green dot right up here. This is historically known as a pattern 5, and if you follow my webinar series or you read the guide to the histograms in the email attached, you'll know that this is a bearish pattern right here, and you can see that the high of the market occurred at a time the banks wanted it to occur at. So this starts to put me in a mindset of watching for stop runs, watching for divergences, watching for failures of green dots. Now we come into 7 p.m. last night in the Asian session, and you'll see this buying pressure signal from this histogram that we were waiting for did not push price higher. Moreover, it was not a higher high green dot. So this is the first place where the banks had an opportunity to sell, or to purchase rather, and they stood on the sideline. So there's a couple things happening here. There are banks driving price into an all-time high at a time they normally buy, and then there are banks at a time they're supposed to continue buying, saying we're not really interested in that buying pressure time right now. We're currently at the 6 a.m. signal, and you'll see that each of the selling pressure times at 11 a.m. yesterday and 12 p.m. yesterday, the banks are stepping in and exercising their right to sell. This morning on the ES, in terms of a large time frame, there's buying pressure in the 9 to 10 o'clock candle, and more of that selling pressure in the 11 to 12 o'clock hour. Things seem to stabilize. If you're going to be watching for that home base touch, if you will, if you're looking for support level trades, you're going to want to watch in the 12 to 1 o'clock hour and the 1 to 2 o'clock hour. The closes of those time bars at 12 and 1 o'clock being most important. There appears to be divergence planned for people coming into the evening session tonight. So if this is in fact an area that the banks are going to drive down from, it looks like the 10 to 11 o'clock hour is when that might happen. Now, one of the things I do is I know that these time patterns are predictive, so I'll go out into the world of news and see what reports might banks use to drive that down. And even though it's an innocuous pattern here, if I said that correctly, I think I did, there's a report at 10 a.m. in AHB Housing Market Index. This could be one of those things, picture in your head, even though we know there's a selling time coming, you could picture some bubblehead saying, the markets fell today because of lackluster results of the NAHB Housing Market Index. Consumer blah 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 went blah blah blah. U.S. import prices as well were down, signaling a reduction in the speed of our GDP, LMNOP, RASP, ECT. And we're looking at the chart saying, well, we kind of knew these things had a good chance of happening anyway. The banks are just going to use those times as excuses to push the markets up and down like bullies. So these are the predictive times forward off to the future that we're watching for on the ES today. And these are the levels that are most interesting to me today over the course of the session here. So keep an eye on these over the next 8 hours or so, and please feel free to use these construction lines. As a matter of fact, what I'll do here, because a lot of you don't own the software, I'm going to put a vertical green line right there for all the buying pressure times, and I'm going to put a vertical red line for all of the selling pressure times. Set that as the default. So you'll have these leading lines on your chart as well. And that should carry you through today's session. So we have a pretty good idea what the ES is going to do. I have lower time frame analyses. We'll be following it live on the 5-minute chart, looking for some really precise entries using those institutional behavior pattern times. If you want to join us, I'll put a link in the email to our webinar on Thursday, and we'll also be sending out histogram forecasts for many of the markets you trade on Thursday, for Wednesday and Thursday. So lots of opportunities to catch the banks with their hands in the cookie jar. If you want to follow the stuff that W.D. Gann said was what he used, these times, these levels, please consider joining us at one of our webinars. We are exposing the times that the banks are using to trade and preparing at those times to move when they move. And so if you're interested in that kind of a methodology, we'd love to have you join us. I'm Michael from Back to the Future Trading. Thanks for joining us here today, and we'll see you guys soon.